Hey, it's Alec Torelli. In this video, I'm going to tell you why I'm betting on a AI startup that's relatively unknown, but aiming to disrupt a $500 billion industry. So this is an exciting one here. I first want to shout out everyone that supported the article I posted on alectorelli.com and X. As a thank you, that article did very well. So I'm following it up here with a video to synthesize my thoughts here. The first thing is I spent a lot of time doing a deep dive on this and to synthesize this. And one of the things I learned is that insurance itself is a very unique space. So before we get into this specific bet, which we'll get into in a minute, the first is why insurance? Okay, so the world spends more money on insurance than just about anything else. This includes things like advertising, AI, defense, electronics, oil and gas, sports, and so much more. So it is a game worth tackling. It's an industry worth attempting to disrupt, and it's a big TAM, as it's called, total addressable market, fancy term in investing. It's a big opportunity if you get it right. And so one of the biggest things that I look for is like, how high can the company go? How big the company get if they achieve their vision, right? So what is the opportunity, right? Then of course you want to think about what is the risk, but at least here it's worth saying that insurance is an industry worth fighting for, as the CEO famously says in his Investor Day presentation. The second thing that I wanted to articulate is that I think the industry is ripe for disruption. I also think this company, which I'll share in a second, is the one to do it, which we'll talk about. But first is like, is the industry highly efficient and there already are like rock star players? Has it already been disrupted, or is it ripe for disruption? I think it's ripe for disruption. I think a lot of the legacy incumbent players have been around for 100 years. And when it comes to AI and leveraging technology, which I'll talk about why I think that's going to disrupt it, it's first important to note that they are, 100-year-old companies. And some people say that's a feature. I think it's actually a bug, because what happens is their systems are very archaic and uncoordinated. And each one is sort of slapped atop the other over decades and decades of incrementally trying to leverage technology to make systems more efficient. It's kind of like a Jenga tower. So remember that game you used to play as a kid? Maybe you still play as an adult. It's actually a really cool game where there's like that wooden tower and there's all the little pieces, and like you take out one piece and then eventually the whole tower crumbles. It's sort of like that, where they're like stacking these pieces on top of each other. Well, in Jenga you pull them out, but you get the idea. They're like building pieces one on top of the other. And so it's very uncoordinated. In fact, Geico reportedly says they have 600 systems that are all uncoordinated. They don't really talk to each other. This is someone from Berkshire Hathaway who owns Geico saying this about their systems within Geico, right? So there's 600 uncoordinated systems, okay? So the new model is going to be one coordinated system built from the ground up that is an AI first company. And I think this difference sounds subtle, but I think it's massive, because this is sort of the thesis in a nutshell, is that legacy players are not going to be able to compete because they are built as insurance first companies that are scrambling to leverage technology and AI, whereas LMND, which is the company in question here, its ticker symbol LMND, is an AI first company that is focused on insurance. So they're an AI company that just so happens to be targeting the insurance market. And that fundamental difference, that distinction, sounds subtle, but it is actually the core distinction. And this is what I call the lemonade standard. And the way I want to present this here is like how industries get disrupted, right? So I'm almost 40. I've seen this happen a number of times in my life. But the most famous example, not the most famous, one of the common examples is the iPhone disrupting the BlackBerry, or streaming video, Netflix, disrupting legacy video like Blockbuster. And, we all remember the famous quote, from the Blockbuster CEO in 2008, Netflix is not even on the radar in terms of competition. At the time, Blockbuster was the legacy giant with annual revenue 5 times that of Netflix. So Netflix was already a company. They were already apparently not on the radar. Of course, they were on the radar. They should have been the huge, big iceberg. But, they were already on the radar of a company that already existed. Yet it seems so impossible that new paradigm could overtake the old paradigm. And of course, we all know what happened. 2 years later, Blockbuster files for bankruptcy. Netflix is now worth $400 billion. So, my point here is that these disruptions happen very fast because they're built on new systems. And those new systems of technology, some people, quote Moore's Law or whatever, but technology accelerates very, very quickly. And the S-curve of disruption happens very fast. So it's, as Hemingway famously says, things happen gradually and then suddenly. And that's kind of the disruption curve here that happens as well. So I think this industry is ripe for disruption. And I also think that the disruption happens very fast. But the other thing that's important to note is that disruptions seem almost impossible as they're right about to happen, right? So it's like before a disruption happens, it seems non-consensus. And this happened in poker. I saw AI come out in 2013. I was in Malta to test one of the first solvers, and it seemed like this solver wasn't that good, and it had a bunch of leaks, but I could already see. I had studied Ray Kurzweil at the time, who talks about the exponential growth of technology that's not linear. I could see at the time that if this thing doubled a couple more times in its capacity, it would be orders of magnitude better than a human. In fact, I wrote a piece called Will Machines Ever Beat Humans at Poker? It was a very counterintuitive take at the time. The humans played the robots, they crushed them. A couple of years later, it was the opposite. The AI was so much better than the humans, it just completely decimated them. That was 2015. And, humans have never been able to beat AI again in heads-up poker format. So these things happen gradually, then suddenly they happen very fast. They happen with many things, and I've seen this transition play out. And so I think insurance is that industry that is next to be ripe for disruption. And the reason I'm so excited about that is because you don't get paid in the markets to bet on something that's consensus. By the time something is consensus, it's already priced in, and a large part of the upside has already been captured. So by the time everyone agrees on something, that thing is already very expensive, typically. This is not financial advice. I'm just a poker player on the internet. You should do your own research. But this is the way that I see investing. I look for things that are very asymmetric. I look for things that are non-consensus, that seem very likely to me to happen because I have information asymmetry, because I've spent 40 hours now on this company, and I understand things about the trends and the market and the dynamics and the industry that the market doesn't see. And when I bet on those things and I turn out to be right, I am going to be rewarded with a large financial upside. Whereas if I lose, I'm going to lose my initial principal. So that's the asymmetry I look for. Poker taught me this very well, which we'll talk more about. But I think it's important, that's my investment approach, is I'm looking for things that are non-consensus, that are kind of like that blockbuster moment where people are like, that would never happen. And then a couple years later, everybody says it's obvious. Why didn't I bet on that? I believe we're at one of those pivotal moments with insurance. And I think Lemonade is that Netflix to the archaic system, which is Blockbuster. So, Lemonade's been around since 2015, which is really impressive, right? They were there long before the AI hype. I get pitched a lot of investments, involved in various syndicates. I raise money for early stage startups. I do my own investing as well, put together SPVs and all that sort of thing. And so recently, the last few years, of course, I've seen many more startups adding AI to their pitch, adding it to their deck, adding it to their domain, adding it to their, the line after the M dash or after the header, because of course it attracts capital. Everybody now is piling into AI. So what I'm really impressed by with Lemonade is they were part of this trend before it was a trend. So if you look at the trend, the dynamics of adoption cycles, there's the early adopters, then there's like the mid, there's the mainstream people, and then there's the laggards. They were certainly one of the very first early adopters of AI. In fact, they say we're a new kind. This is April of 2015 in their founding thesis. We're a new kind of insurance company built on AI and social impact to delight customers, collapse costs, and quantify risk like never before. So they've also delivered a lot on their benchmarks and their projections going back many, many years. I've looked back to 2021, and they were pretty spot on with that. I talk a lot more about in the article on alectorelli.com or on X at Alec Torelli, so I won't belabor it here. But one thing to note is from their 2024 Investor Day, they pretty much hit all of those milestones in 2026 that they said they were going to hit. And the next one, which is becoming profitable, they're expecting to hit in Q4 of 2026 as well. And apparently they're on pace to do that as well. So they've been consistently been able to deliver. And why I think this is so important is because I've learned this the hard way, that when it comes to founders and a team, their ability to execute is paramount. And the best founders and the best team can make many businesses work, but the worst founder or the worst team can't make even an exceptional business work. So just the fact that this is an industry ripe for disruption and it's a good business idea doesn't mean it's going to work. You need the jockey and the horse, I guess is what I'm saying. And I was really impressed watching Daniel Schreiber speak so eloquently and simply and articulate. I don't say this lightly. I read Steve Jobs' autobiography, and I've watched, almost every interview about him I could find. I was fascinated with his approach towards being a visionary. But Daniel Schreiber has a little bit of that characteristic of his ability to articulate a compelling future, a vision of the future that's radically different than the present, and really get you to understand it in a simple way and to buy into it. And his Investor Day presentation was incredible. So overall, I'm impressed by the company. I'm impressed by their history, and I'm impressed by the team. And so Lemonade has some really key distinctions here. they get a lot more efficient as they scale as a company. So one of the things that is really challenging to do as a company scales is to maintain its efficiency. So typically what happens is as companies get bigger, they get less efficient. But Lemonade seems to be kind of like defying gravity and actually doing the opposite. And they've achieved this across many seemingly impossible metrics. And they predicted this years ago, and they've hit those milestones. So one of the metrics that shocked me as someone that's been in digital marketing for 15 years or so is that they run various forms of online paid traffic. And they've basically been able to keep their CAC to LTV is kind of like the gold standard of metrics. They've kept that at 3x, which basically means they've kept their acquisition costs the same as they've scaled. But anyone who has run paid ads knows how hard that is to do. So they have certain metrics that they've done very well. Another one that's really impressive is their revenue that they're generating per employee. They started at 500K. They predicted it would get to $1 million, and it did on schedule. It's now $1 million per employee, but they're predicting that will get to 4 million. So the CEO put out this beautiful, elegant chart. And you can see here in the pink line, it's the business growth, and the black line at the bottom is the operating cost. And the idea behind Lemonade is that because they're fully integrated with AI and technology, they can scale the business over time, getting more and more efficient, but the cost of scaling will stay the same. In fact, actually, they put out in their recent earnings call, which came out a week or two ago, that they actually decreased their headcount while increasing their revenue. So they've gotten more efficient as they've scaled. This is not some super small company. They've done $500 million in pet insurance alone. They're the fourth biggest pet insurance company in the US. So this is like already at a sufficient level of scale. They're $5 billion market cap company. And they've proved that they could do this over time. So this is incredibly unique in the insurance space. And I think this is part of that like vertically integrated AI that they have, where they're like an AI company from the ground up that is building something on the correct architecture, kind of like Netflix is building video on streaming, right? You can't really say like Netflix is a video platform. They're like a technology company that happened to disrupt the way that we consume content. And so it's just a completely different paradigm. And Lemonade has that same architecture of efficiency and technology, but applied to insurance. The next thing that was super fascinating to learn about insurance is how sensitive consumers are to changes in price. And this is important because Lemonade reports a 50 to 150% increase in their conversion of a lead into a customer for every 10% change in price. So if the price is 10% lower, they are doubling their conversion. This is what's called asymmetry, meaning the increase in conversions is very high for a very small change in price. Now, this is crucial for their thesis because if a company can reliably deliver a competitive product at a lower price, it stands to reason that they'll dramatically increase their market share. So the question is like, can Lemonade do that? Can their technology advantage help them do that? And it's actually a quite interesting rabbit hole, but I would say the answer is definitively yes after looking at this. This is my opinion. And they uniquely leverage AI to offer the best prices. And so this happens in many ways. I'm going to cover a few in this video. Again, most of it's in the article at alectorelli.com or X at alectorelli. Encourage you to check that out. But one of the things that insurance companies do to understand driver behavior is they use what's called telematics. So telematics is basically a fancy word for collecting data. Now, the way they do this and the efficiency to which Lemonade does this is one of the many things that makes them very unique. So how it works is most legacy companies are very inefficient at doing this. They collect data based on things that are not necessarily relevant to exact driver behavior. So the way that they're pricing the risk of the drivers ends up being inefficient. So bad, inputs in, bad outputs out. And so they use things like credit score or age and things, gender, whatever, things that don't necessarily correlate to driver behavior. Now, telematics is revolutionary because it tracks specific things like every mile driven, looking at relevant factors like braking speed, swerving, how often you accelerate or decelerate, etc. So the result is a much better picture of the actual driver risk. And so this is super unique because it's key to pricing
risk. So superior telematics, superior data, superior risk pricing will lead to the ability to have a more efficient model, price drivers more accurately, and potentially be able to offer more competitive prices. So this is basically the flywheel that, let's say, Lemonade has: better data, more accurate pricing, lower pricing for safe drivers. Now, what's so interesting about this is that 2/3 of drivers are good drivers, let's say, and 1/3 of drivers are below average. They're bad drivers. Okay, so there's like average, 2/3 are good, 1/3 is bad. And basically the 2/3 subsidize the 1/3. And so drivers that are priced as average are very much a mixed bag, because if you're pricing everyone very similarly because you have poor data, the reality is that really good, safe, conservative drivers are paying too much to subsidize the 1/3 that are poor drivers, that are high-risk drivers, that are paying too little. And so what Lemonade could do is they have better telematics for various reasons. They also use more continuous version of telematics. So most companies, they measure your driving for 2 weeks or 3 weeks, and then they stop, and that's your premium over time. What Lemonade does differently is they measure your driving continuously over the course of the year. And why that's important is because they found that the continuous measurement leads to a 23, I think, percent change in risk profile over the course of the year. Now, we already established small changes in risk lead to large changes in conversion because drivers are very price sensitive. So if you could really hone in on that data and you could capture that inefficiency that the market is not, you could more accurately price drivers. And again, why this is so interesting is because you could see in this graph here, let's say Jill is a distracted driver and her premium is about $3,000, and Jack is a careful driver and his premium is about $2,000. The average driver is right in the middle there, $2,300. So if you could find the safer drivers and attract them by offering them a fair premium because they are safer, they cost you less, they are less risky, they are going to be cheaper at Lemonade, because Lemonade can price them more appropriately for their risk profile. Now, if they are more expensive because they're a bad driver, their premium will be more expensive at Lemonade, which seems like counterintuitive. Oh, well, it's more expensive at Lemonade. Actually, that's a good thing. It's a feature, not a bug, because those poor drivers will go to the competition and they will be mispriced as average elsewhere. So the competition will be taking on higher risk drivers, pricing them as average because they have worse data. And so Lemonade attracts the safer drivers at a lower price who are less risky, and it repels the more expensive drivers. So they basically use how this works. Lemonade, according to their report, they use basically 100 times the telematics as other people. They use 10 times the telematics, 10 times more efficiently, or some combination of those. So they basically use way more data to capture this accurate pricing. And this is critical. Think about that 15% number, right? 15 minutes could save you 15% or more on car insurance. Geico built, $50 billion business largely on that, much on that tagline. And so imagine, Lemonade being able to save people 10% or 15%. It's huge. They found, and I'm looking at their data here, they observed that their unique system can lower premiums by 15% for 2/3 of customers and 25% for 1/4. And this is well above that critical 10% threshold, which doubles conversions according to their data. So this is key of what they're doing. This is all baked into their integrated vertical system of AI, being the basis, the foundational layer for how they operate. So this is just one of the things they do. They also have this AI is integrated everywhere, right? So think about the claims process, right? How disastrous is it and stressful to make a claim, and number one, have it take a long time. It takes a lot of time, effort, resources, and stress, but also not know if that claim is going to be paid. So Lemonade has some incredible data when it comes to this. They have 2 AI agents. Well, they have multiple, but one of them is Maya, who does sales. So Maya is the sales agent, named after one of the people on the staff, and Jim is a claims settlement agent. So 98% of the policies, 98% are sold automated through the AI agent Maya, and quotes are done in 90 seconds. So this is all done through an app. It's instant, immediate. 55% of claims are processed instantly by Jim. So you file a claim, you get processed in 3 seconds. I mean, that is unparalleled and unbelievable. It's no surprise they have a lot of raving fans. And what they found is that a lot of their sales are cross-selling. So they are selling to an existing base, and those numbers are apparently up 6x since their last report. So it's very impressive because people, once they get in the Lemonade ecosystem, they're staying. And a basic premise of marketing, if you've ever done lead acquisition or marketing, it's much easier to sell an existing client a second service than it is to acquire a new lead. Acquiring a new lead is expensive. Selling more to an existing lead is a lot easier for the obvious reason that you already acquired them. If you're good at what you do, whatever your business or service is, that person trusts you. It's a lot easier to cross-sell or upsell, however you want to think about it, that existing lead. So Lemonade found that those numbers are growing dramatically within their business, largely because of their amazing product. Talk to people that have used them. They absolutely love them. One thing that's interesting about Lemonade is they also benefit from this great rotation thesis that I have. It's part of a larger thesis of the idea that as the boomers, which are a large part of the population, pass along their wealth to the millennials and below, the behavior of the new generation that inherits that wealth is going to be very different. They're going to do different things. And this is not necessarily true, in the past, where society changed so dramatically in such a short period of time. As you can tell, even there's different social medias for different generations that are, 10 years apart, right? Some people are on Facebook, some people are on Instagram, then the younger generation's on Snapchat and TikTok, right? And so that's like a generational behavioral pattern. And so we haven't seen that in the past. So my great rotation thesis largely came from my study of the history of money and Bitcoin, which is basically that boomers are going to own gold and not Bitcoin, but the millennials and Gen Z are going to own Bitcoin and not gold. So that great rotation thesis is going to transform society's store of value mechanism from gold to Bitcoin, and Bitcoin's of course going to benefit. But the interesting thing about Lemonade and why this relates to the great rotation thesis is that 70% of Lemonade's clients are 35 and under. So as boomers might not use Lemonade for insurance. It's on an app. It's not really, they've been in Geico for a lifetime. Fine, State Farm, whatever they use, great. But the newer generation, in fact, everyone I've talked to that uses Lemonade is younger, right? And so as those people become older and then they have kids, or they have, the younger generation starts buying insurance, where are they going to go? Lemonade is capturing that market in the same way that Robinhood is capturing the younger traders. They're not going on to Interactive Brokers and Schwab. They're using Robinhood. So people think Robinhood is a great rotation thesis. I frankly do as well, but it's very crowded. It's a crowded trade. Lemonade is a new trade on the great rotation thesis. And so I think all these are going to be future of the Lemonade standard, which I introduced earlier. The idea is after Safety and Amos, who created the Bitcoin standard, which is basically that Bitcoin is going to redefine the standard of what it means to store value and money, because it's a new technology, it's a new form of storing wealth, better than anything ever discovered before, frankly. And so I think Lemonade is kind of like that for insurance. I think this efficiency and this new customer experience of insurance actually being something that is pleasant, as opposed to something that's stressful, is going to be the Lemonade standard. And so maybe this term will catch on. You go ahead and use it. I'd love if you did and share it. Let me know what you think. But I think this will hopefully be a new paradigm for insurance as Lemonade grows. One of the risks I hear people talk about is, won't other companies adapt? And they could use data as well. They could use AI as well. They could leverage AI as well. So one thing that's really interesting is the CEO wrote an amazing article. Came out recently, actually. Dana Schreiber's amazing ability to articulate an idea very simply. So I encourage you to read his blog as well. But I'm going to paraphrase some of the stuff from it that's really fascinating, and it kind of showcases why I don't think other companies will adapt and why they haven't throughout history. So he uses this example called the Amazon bomb. It's a Barron's article from 1999. Assures readers, quote, that once Walmart decides to go after Amazon, there's no contest. And so Schreiber, funnily, writes amusingly, Barron's got one thing right. There was indeed no contest. In fact, Amazon is now worth, $1 trillion more than Walmart. And they also took out a lot of these other companies that apparently could have pivoted, right? Where it happened to Borders. I remember the day Borders bookstore closed. I remember going to the last Borders in my neighborhood. It's actually very sad. It was frankly very sad that Amazon put Borders out of business. But a lot of other stores closed. JCPenney was huge. Circuit City, I remember Sears, Toys R Us, Radio Shack, all these were, massive giants at the time. They could have all pivoted to, Tower Records was something that was amazing when I was growing up. They could have all pivoted to selling all those things online. Of course, none of them did, just like Blockbuster didn't pivot, BlackBerry didn't pivot. And so he kind of talks about like why this is a thing. We've seen this play out time and time throughout history, and people always think that the incumbents will pivot, but history shows the opposite. The incumbents don't pivot, and frankly, that's why they get disrupted. But with this industry specifically, it's not even clear that they want to pivot. So it's like some of the time you would think that people learn from history. They say history doesn't repeat, it rhymes. Frankly, people don't really learn from history. But But like you would think they would want to pivot because it's so obvious that this has happened so many times in recent history. It's not like you have to go back hundreds of years to see disruptions, because disruptions happen very quickly with technology. But it's not even clear that people want to pivot. Of course, other companies are going to use AI. Nobody's doubting that. But the really question is, can they re-architect themselves to close that gap that Lemonade has? I would argue that as AI increases in its ability, that increases the gap that Lemonade has, because they're leveraging AI so much better than all the other companies. So I think the gap gets wider, not narrower, because the other companies aren't seemingly adapting in the same way that Lemonade is going all in on this. It's almost laughable at this point, frankly. It's not even clear they want to in the first place. But apparently also a quote from Ajit Jain from Berkshire, who Schreiber quotes in the article. He said their approach to AI is, quote, wait and see. And as a whole, he says a recent study finds the average executive is, quote, waiting until the ROI is clear. But, reality, frankly, hums to a different tune. By the time the ROI of streaming was clear, Blockbuster was out of business. I don't think this will be any different. Frankly, I think it's even less likely they adapt because technology grows exponentially. So the use of technology, the integration of technology is faster today than it was in the past. So it was easier to potentially integrate a new paradigm in the past because you had more time. As we've seen, the rise of AI. Lemonade's been in this since 2015, but if you use ChatGPT, the first one in 2022, and today, it's a massively different experience, and that's only been a few years. So we have less and less time to update with new technologies than we had in the past. So I don't think this time is going to be any different. In fact, I think I'm obviously betting that it's not going to be different, but that's for you to decide. So I guess the last thing is where can this go, and how do I think about this investment and this bet, right? I think it's a bet because there's upside and downside. So people love price predictions. I know that's a huge thing. There's a really interesting pricing model that I share in the article, so check that out if you want to model this out for yourself. But one thing I like to look at, and I share here in this chart on the article here, hopefully you can see this, is basically looking at the value of the company now and compare that to the other companies and then projecting where you think it could go, right? So I had this chart drawn up. Lemonade today is 0.17% of the whole industry. So 0.17 of 1%, okay? That's Lemonade's size. The largest player, State Farm, is 108 times bigger than Lemonade. So if Lemonade becomes State Farm, they grow 108 times, assuming State Farm doesn't grow at all. So, that's the kind of the ceiling, right? That would be the best case scenario is you become number one, right? So it'd be 108x from here. But even becoming number three, in between number three and number four, you could see that would be about a 50x, right? Between 46 and 57x, right? Between Geico and Allstate. And that's not even number one. That's, becoming number three. So maybe that's reasonable. Maybe a 50x is a reasonable upside. Of course, the timeline depends on your investment horizon. I'm an investor, not really a trader. I'm not trying to swing trade this. I'm not trying to look for a 5% bounce off the low or something like that. I'm trying to hold this for a decade. And I really look for things where there's asymmetry, right? So of course, the risk is you can lose all of your money if this company goes to zero. I don't think that's realistic, frankly. Maybe it goes down 50% or something like that. You can always, sell and reevaluate, whatever. But let's say the downside is, 0.5, so half of your investment, maybe 1 if you lose the whole thing and you ride it to into the sunset. But what is the upside compared to the downside, right? And how likely is that upside compared to the downside? So if the upside's 50x and the downside's 1, I don't even think the downside's 1, but let's say it's 0.5 and the upside's 50, that's 100 to 1 delta, right? You could win 100 times more than you can lose. So you don't have to be right every single time when making this bet, and you obviously need to use portfolio management and bet sizing, just like I do in poker. It's you don't put all your money in a single tournament because you can bust even if you have 2 aces. It's just basic premise you learn in bankroll management. Investing is the same way, especially in higher risk investments, right? You don't put all your eggs in one basket, but I'm looking for things where there's a lot of asymmetry, and I'm looking to realize that asymmetry, make diversified bets, so maybe find 10 or 20 different lemonades, which I'll be sharing more about on this channel on my social media. Follow along at Alec Torelli or alectorelli.com. I'll share more of these. You can subscribe to the newsletter. It's free. It always will be. And I'm happy to share all these trades and investments I'm making. But yeah, so that's kind of how I look at this, right? It's not all my eggs are in one basket, and I think finding multiple ones of these that are not correlated is a great way to play portfolio construction for me personally. So that's kind of how I'm thinking about this bet. I'm in this for the long term. I'm hoping to go to their investor conference in New York this year. It's one every 2 years. That's in November. I'm really excited to learn more about that. And yeah, ultimately, I'm super bullish on this. I think it's a great opportunity, and I just love the risk reward of this play. Anyway, I'd love to hear your thoughts. That's it for me. Leave them in a comment below. Subscribe to this channel. If you like this, please share it with someone that you think would benefit. That's why I do these. These are free. They always will be. And let me know your thoughts in a comment. Follow along. I'm Alec Torelli. Hope you enjoyed this. See you in the next one.